Are you tired of feeling overwhelmed and confused by the world of option trading? Do you wish you could learn the basics and start making money in a short amount of time? Look no further. In this video, you'll learn the key concepts and strategies you need to know to get started with option trading, all in just a few minutes. So grab a coffee and get ready to boost your trading skills and your bank account. Okay, so before we begin, I'm gonna talk about some terminology that you're gonna need to understand. The first one is option series, option class, and contract size. Okay, so all calls or puts of the same class, the same expiration month, and the same strike price are called an option series. For example, the IBM December 170 calls are a series. Option class means a group of options that represent the same underlying. Buying one contract usually gives the holder the right to buy or sell 100 shares. This number is referred to as the contract size. There are two types of option. There are calls and puts. Calls give the holder the right to buy an underlying asset like a stock at a certain price. The writer of the call has the obligation to sell the underlying asset at that price if the holder decides to exercise their right to buy. I know it's a little complicated, but basically you can sell a call and you can buy a call. You have the obligation to do it. You don't have to, but you can. Now, puts work the opposite way. The holder of a put has a right to sell an underlying asset at a specific price. And I'll go a little bit more in detail about that so you could really understand it, because it can be kind of complicated. And of course, the writer of the put has the obligation to buy the underlying asset at the price if the holder decides to exercise their right. Okay, the price of an option is called its premium. The premium is expressed in dollars and cents per share, and it's how much the buyer of the option pays for the right to buy or sell the underlying asset. The premium of an option is made up of two parts: intrinsic value and time value. Intrinsic value is the amount by which the option is in the money. This means that if the option gives the holder the right to buy or sell the underlying asset at a specific price, and the current market price of the asset is higher or lower than that price, then the option has intrinsic value. And I'll go a little bit more in detail about that as well. Now, time value is the remaining part of the premium that's not intrinsic value. It reflects the possibility that that option may become more valuable in the future. If an option has less time, the chances of it becoming more valuable in the future are much lower. Does that make sense? Now, the Greeks is a financial metric used to evaluate the risk and probability of options and other derivatives. Okay, so here are the Greeks. There's delta. Now, delta is a Greek that measures the rate of change of an option's price with respect to the underlying asset's price. It can be thought of as the option's sensitivity to change in the underlying asset's price. Also thought of how much your option premium will go up per dollar that the stock goes up or down, depending if you're writing puts or calls. The next one is gamma. Gamma is a Greek that measures the rate of change of an option's delta with respect to the underlying asset's price. It could be thought of as the option's sensitivity to its own sensitivity. It is how delta is affected. The higher the gamma, the higher the impact on the change in delta, and vice versa. The next one is theta. Theta is a Greek that measures the rate of change of an option's price with respect to the passage of time. It can be thought of as the option's time decay. The higher the theta, the faster the time decay will be on the premium. The next one is vega. And this is actually going to be the last one I'm going to talk about because the other one isn't really as important. Vega is a Greek that measures the rate of change of an option's price with respect to changes in volatility of the underlying asset. It can be thought of as the option's sensitivity to changes in volatility. If you don't know what volatility is, it's basically how active a stock is. It's how much trading is going into the stock, how much it moves. So basically, when a stock gets a lot of hype, this will change the options premium, and it will change it depending on how high or low the Vega is. The next Greek isn't as important, but I'll just say it here just so you can get the value of this video, and that's rho. Rho is a Greek that measures the rate of change of an options price with respect to changes in interest rates. Now it's basically the same as Vega, but instead of volatility affecting the premium, it's interest rates. And the way you actually determine how high the volatility is in an options contract, that's actually IV, that's implied volatility. And this is a great way to determine how much hype the contract has. The higher the hype, the higher chance you have of it dropping, of course. So you want to look for some that aren't too high, because when you have a low IV, the higher it goes, the higher the premium on your contract goes. So it's a good way to flip contracts by just doing that. There is a strategy where people buy contracts a couple months or even weeks before earnings comes around, because the IV is low. And as we get closer to earnings, there's a lot of hype about whether the company is going to have a good earnings or a bad earnings. As a result, the IV increases, causing the premium to go up. And from there, you could really just sell the option contract and make a quick flip like that. Another thing to note is that when you are thinking about buying an option contract, it's important that you check how much volume each contract has, because that's going to allow you to go in and out, sell your contract, buy your contract as quick as possible. For that very reason, it's important to trade stocks that have a lot of volume when trading options. And these stocks are going to be like Apple, Microsoft, Tesla, IBM, AMD. These companies have a lot of volume in option trading. Okay, so now we're going to be talking about how you could buy a call and how calls work. So I'm going to be explaining this in Robinhood. So if you don't use Robinhood, you could still try to follow along, because the concepts I'm going to be explaining are still universal and you will understand it no matter the brokerage that you're using. Okay, so why buy the right to buy the stock when you could simply buy the stock? Whether the stock or the call is preferable depends greatly on the trader's forecast and motivations. For example, consider a long call. You buy one Intel June 22.50 call at 85 cents. In this example, a trader is bullish on Intel. He believes Intel will rise at least 20% from 22.25 per share to around $27 by June expiration, about 2 months from now. He is concerned, however, about downside risk and wants to limit his exposure. Instead of buying 100 shares of Intel at $22.25, which would be a total investment of $2,225, the trader buys one Intel contract, 22.50 call, at $85. So that's much less than $2,225. And you're getting, if not equal to the same amount of investment. The trader is paying $85 for the right to buy 100 shares of Intel at $22.50 per share. If Intel is trading below the strike price of $22.50 at expiration, the call will expire and the total of premium of $85 that he or she paid will be completely lost. The trader will not exercise the right to buy the stock at $22.50 if he can buy it cheaper in the market, right? So therefore, if Intel is below $22.50 at expiration, this call will expire with no value. However, if the stock is trading above the strike price at expiration, the call can be exercised, in which case the trader may purchase the stock below its trading price. Here the call has value to the trader. The higher the stock, the more the call is worth. For the trade to be profitable at expiration, the stock must be trading above the trader's break-even price. The break-even price for a long call is the strike price plus the premium paid. The stock is literally bought at the strike price, which is $22.50. So the strike price is $22.50 That's what it's bought at, but the premium is 85. We're paying 85 for the ability to have this. So that's kind of how you determine your break-even price. Majority of the time, you'll be able to find your break-even price within the right here in Robinhood, and in any brokerage, they will tell you the break-even price, followed by the Greeks and the implied volatility. So when you open up the options chain, you're going to see a set of dates at the top. That's known as your expiration dates. If you buy a long call, the premium will typically be more expensive. If you buy a weekly with no time, the options are going to be a lot cheaper because they don't have that time value in them. If you click on the individual contract, you'll get a set of information such as the Greeks, the implied volatility, the break-even price, and all the important information you need to know. So just click on the option contract, and right there you'll actually see the IV as well. You'll see the theta, the gamma, the delta, the volume as well. So, and as well as the open interest. Now, open interest is basically a calculation for the expected movement of the stock. Once you decide the strategy that you're going to be using in option trading, whether it be long calls, puts, long puts, short calls, if you are going to day trade or swing trade, it's important to get a cash account on Robinhood. Cash account basically allows you to day trade. A day trade is when you buy a option contract and you sell it the same day. So it's important to have a cash account because that's going to allow you to day trade every single day. It's also very important to understand that if you are trading weeklies, the delta is always increasing constantly every time you hold on to that contract. So when you do buy option contracts, you want to flip them. I say control your trades. I limit myself to 4 trades throughout the week. I never trade on Fridays. And always remember that the theta decreases faster on in the money contracts versus out of the money contracts. So you have to be very correct about your predicament of where the stock is going to go. Another thing you need to know is that when you are buying puts, the in the money is actually above the strike price. And for calls, it's the opposite. The in the money is whatever's below the stock price. So the reason that is because when you are buying puts, you're betting that the stock's going to go down. And with calls, you're betting that the stock is going to go up. And then at the very end, all you got to do is put one contract. As you can see, one contract is $165. I can choose to increase the contract size by getting more contracts, and this will give me an even higher profit potential. And then this is where you can make a lot of money with options by knowing what you're doing and trading with more contracts. Now, the limit price is basically how much you're willing to pay for the contract. Okay, if you want to pay the most, and I do 1.86, the price changes. Now it's 184. The lower I pay for it, the lower the chances I'll get filled for that order right away. Whereas if I pay them the highest, I will most likely get that order fulfilled quickly. Now, it's important to understand that a PL chart tells you how much you can win and how much you can lose. The max loss is whatever you put in. That's how it is for every type of option play. Not every single option play, but. And then your max gain is obviously unlimited because it's whether you're buying a put or a call. In this case, a put, the potential of the stock falling to zero is always there. Now, the chances of it actually falling to zero, slim to none, but there's always that possibility that you can. As a result, that's your max profit. Now, I have this website called Option Calculator. This is the last thing I'm going to show you guys before I end this video. If you do make a play, come to this calculator and go ahead and just input your play, put the ticker symbol, and then find your option contract, and it'll actually give you a visual representation of how your contract will move depending on how the stock moves. So, for example, if the stock didn't move at all, I would be losing money. But if it went down the first day, I'd be gaining a good amount of money. Obviously, remember that when you're trading options, you don't want to hold the contract unless it's a long position. If it's a short position, you want to buy it, sell it, flip it, just like that quickly. Anyways, guys, that's it for the options tutorial. I will have a part 2. Talking about selling calls and selling puts in another video. So if you guys enjoy, please